Hello, welcome to this brief presentation about importing goods in Canada. First of all, I would like to introduce myself. My name is Jocelyn Boucher, and I'm practicing in the indirect tax area for more than 25 years. I'm with Hardy Normand since 2013. Hardy Normand is a mid-sized accounting firm located in Montreal, Canada. With approximately 100 professionals, we can provide audit, accounting, consulting, and tax services. Our clients are mainly small and medium-sized companies operating in all spheres of activities. And Hardy Normand is also a member of Elliott Group since February 2013. We are represented in Elliott meeting by Valérie Ménard, a tax partner, and also Roger Najim, an audit partner. Today I will try to explain you the basics of importing goods in Canada. The presentation will be focused on the goods and services tax, and I will not discuss the custom duty, custom rates, or custom classification. If you need additional information on customs, please contact me. Any tangible personal property that crosses the border in Canada will be subject to a 5% goods and services tax, commonly called the GST. The GST is also applicable on services rendered in Canada, as well as on intangible personal property that could be sold in Canada. But the tax treatment will be different than those discussed today. The GST is a value-added tax, similar as those frequently used in Europe, and our GST legislation is copied from the one in the UK. The tax is payable on the value for duty, plus any additional custom duty that would be payable, and is payable by the importer of record. The tax is collected by the Canada Border Service Agency and is payable at the time of importation. There are some exceptions that do not attract GST, such as medical device and basic groceries. These items are not subject to tax even when they are sold in Canada. As a value-added tax, the GST is payable at each level of the distribution chain. Consequently, it can be recovered by registrant. The term registrant also includes a person that is required to be registered. The registration is not limited to Canadian company. In fact, foreign company can also register for the goods and services tax if they have commercial activities in Canada or if they solicit order goods to be delivered in Canada. As an example, a company that sells furniture and would like to extend his sales territory could come in Canada and register for the tax. For foreign companies that decide to register, there are naturally some compliance issues, such as having to secure a surety amount and also the necessity to produce GST return. Those returns can be filed annually, monthly, or quarterly. We will come back on compliance issues later on. In some cases, the non-resident company will be required to register. That will be the case if the non-resident company has sales employees located in Canada, or if the company leases space for storage in Canada. Then the registration becomes mandatory and is no longer made on a voluntary basis. If the foreign company decides to register, it will have to collect and remit the GST on all supplies delivered in Canada. The company will also be entitled to a refund of the GST paid at the border, as well as GST paid on any other expenses incurred in Canada. The amount to remit to the Canada Revenue Agency is the difference between the tax collected and the tax paid to suppliers. It is important to remember that if the tax paid to suppliers exceed the amount paid or charged to your customer, then a refund will be granted. The registration can then represent important savings for non-resident company doing business in Canada. The harmonized sales tax is an extension of the goods and services tax by adding a provincial component in some particular province. It is the same legislation than the GST, but there are various rates, and also please note that the provincial component is not collected by the Canada Border Service Agency at the border. There's various rates, and for example, in Ontario, New Brunswick, And Newfoundland, the rate is 13%, 15% in Nova Scotia, and 14% in Prince Edward Island. The province of Quebec has a similar tax to the GST, which is called the Quebec Sales Tax Act, and the other provinces normally impose sales tax, but at the retail level only. Having said that, and hopefully you understand the basics of the GST, I would like to present you 4 scenarios that will normally cover the majority of the transaction involving a foreign company selling goods in Canada. In scenario 1, the non-resident company is selling goods to a Canadian customer, but the delivery, the FOB point, occurs outside Canada. The Canadian customer clears the goods at the border and can claim the GST paid at that time if he is a registrant. In such case, the foreign company is not affected by the transaction. Although it is the easiest way for a foreign company to do business in Canada, Canadian client often prefers to have the goods shipped at their business place and not having to worry about clearing the goods at custom. This will be discussed in scenario 3. In the second scenario, the situation is quite similar as scenario 1, with the exception that the non-resident supplier is registered for GST purposes. Since the goods are delivered outside Canada, the fact that the supplier is registered for GST purposes does not change anything, and the supply is made outside Canada. The supplier doesn't have any GST liability. The third scenario, in this case, the goods are delivered in Canada by the non-resident supplier. The supplier is not registered for GST purposes. The supplier pays the GST at the border, but cannot claim it back. There is a mechanism where the non-resident can provide sufficient documentation, which is the B3 form, the importation documentation, to the Canadian company to allow them to claim a refund of the tax paid at the border. However, business-wise, it's not the best practice, and it's not sure that the Canadian client will reimburse the foreign company for the credit he got by CRA and for the tax that has been paid at the border. If the mechanism of refund is not applied, the goods will be 5% more expensive than those available on the local market. We've seen a lot of situations where the GST paid at the border was lost without any recovery, which could have been avoided with a proper tax planning. In scenario 4, this is the most common practice for non-resident suppliers who wants to register. We have the non-resident selling goods in Canada to a Canadian client. The terms of sales are FOB Canada. The non-resident is registered for GST purposes, and he pays the GST at the border. The non-resident must charge GST or HST to its customer. The non-resident must remit the difference between the GST paid at the border and the GST collected from its customer. In this scenario, the non-resident can compete on an equal basis with Canadian suppliers, without business concern transferred to the Canadian company. If the supply is made in a participating province, the supplier will have to remit the difference between the HST collected and the GST paid at the border. If the supply is made in a non-participating province, the amount to remit should be close to zero, or maybe a small refund if the non-resident has paid GST on other expenses. As you can see, each situation is unique, and we must consider all the facts before giving any recommendation. Also, in some situations, drop shipment rules can be applied. This will be the case where a Canadian client buys goods from a non-resident, but at the request of the Canadian client, the goods will be delivered to a third party in Canada. These rules are quite complex, and feel free to contact me for any additional information. Compliance issues. The return and the payment must be received by Canada Revenue Agency within 1 month after the end of the reporting period. Penalties will be applicable for late filing, and interest will be payable on late payment. If the foreign company pays in a foreign currency, there may be discrepancies with the exchange rate, and this could generate the imposition of penalty as well. The major difficulty for foreign company is often the delay for producing or filing the returns and paying the amount in due time, within the deadline imposed by the Act. Hardy Normand can naturally help foreign companies with the registration process, bookkeeping, accounting for tax, filing GST return, and communication with tax authorities. I hope that you have found this presentation useful, and for any additional information, please contact me, Valérie or Roger. Thank you, and have a nice day.